Hello guys, this is ObaFX Trading Academy and welcome once again to my YouTube channel. As you all know, this channel is dedicated to dropping educational videos on how to trade the financial market. So we've been doing a series of top-down analysis of different financial assets, both Forex, crypto, commodities, and derive synthetic indices. So today, as part of a continuation of this series, we'll be looking at GBPAUD, which is a currency pair. So for those of us that have been following this channel, we understand that I use three basic tools in analyzing the markets, which are the trend line, the Fibonacci retracement tool, and the support or resistance zone. Without wasting much time, let's get into it. Now, I like starting my analysis from the higher time frame. That's either the weekly or the monthly time frame. And as we can see on my chart, this is the weekly time frame. So what's very easy for us to spot in looking at this time frame is that the market is in an uptrend. Now, what do we mean when we say the market is in an uptrend? It means that the market has been making a series of higher highs and what higher lows. So an uptrending market is one in which price makes a series of what higher highs and higher lows. Now, what do we mean? If this is a high, this would be what a higher high, a higher low, a higher high, and higher low. So we say this is a higher. We say this this is a high. This is a higher high because it has succeeded in taking out the previous what high, and this is a higher low because it has succeeded in taking out the previous low. Now that's a simple definition for an uptrending or bullish market. And if we compare this excuse me, to what we have here, we can see that there's a strong similarity. So this gives us an opportunity to impute our very first tool, which is what a trend line. So basically, what we try to get from the higher time frame, it's the general or the overall direction of the market. So we've succeeded in getting this information that the GBPAUD pair is in an uptrend. So let's go to the daily time frame to see if this time frame will give us concurrent information. And from what we can see that just as we've seen on the weekly time frame, that the daily time frame shows the same thing, that the market has been making a series of higher highs and higher lows. However, there's something that we can also spot here, excuse me, that the market is currently ranging on the daily time frame. Now, how do we mean? If I'm to put this here, we can easily spot that the market has been ranging between resistance and what is support zone. So we say ranging market is one that moves between the support and resistance zone. Now, this support and resistance could be horizontal as we have on our chart, or it could be what vertical as the case may be in a channel. So if we look at what we've drawn here, you can see that it is also similar to what we have in the market. Another thing that I can spot also in this daily time frame is that there is room for us to add an internal trend line, in the sense that if I put this here, I can have what an internal trend line. Now I call it an internal trend line because it is the trend line that relates more to the most recent happening in the market. So as we can see, price made the first touch here, second touch, and price is currently making a third touch of this trend line. So we've been able to bring in two things into this market. From the weekly time frame, we're able to discover that this market is in an uptrend. And then on the daily time frame, though daily time frame supported our observation from the weekly time frame that the market is in an uptrend, but we're also able to spot now that the market is currently ranging. So the market has made a higher high, made a higher low, and instead of going back, okay, let me use this. Market just made like a higher high, came back to make what? A higher low. Now, instead of going back up to make what? A higher high, the market is currently what? Ranging, still trying to decide if it will go up or downwards. However, because the market is ranging, we can as well apply the rule for trading what? A ranging market. Now, to trade a ranging market, we usually sell from the resistance and then we buy from the support. As you can clearly see here, when price got here, this resistance zone, the sellers pushed price down, and when price came back to the support zone, the buyers pushed the price up. So now there are two things that we've been able to add. We've added our support zone, and we can see that the support zone is coinciding with our internal trend line. So that gives us what? Two out of our three tools that we normally use. And to make this more beautiful, these two tools are coinciding with each other at the moment, which means that we have a strong key zone to trade from. And this key zone is this support zone created by both the horizontal support and the what vertical support in the trend line. So just to see if we can have an added confluence, if I'm to zoom this in, I can now bring in my Fibonacci retracement tool. Now, if I take this from the swing low to the swing high and I extend to my right, I can see that we can all see that this Fibonacci retracement tool, there's a zone I call the golden zone, and that's the zone between the 0.5 and 0.618. Now, I call it the golden zone because from experience, it has shown me that it holds the highest probability of rejecting price, either when it is acting as a support or a resistance. Now, to confirm that we've been on the right path with our analysis all along, we can see that this Fibonacci retracement zone 2 just shows us that our initial support zone and even our trend line falls within the same area as the golden zone of our Fib 2. In other words, if I'm let me change this to the golden color. So even if I didn't have the support tool or this trend line tool, can see that just by merely imputing the Fibonacci retracement tool, it shows us that price has gotten back again to our golden zone. Initially, price was retraced back to the zone, and even while ranging, price is still being supported by this tool. So let's take this out and go to the next lower time frame. So all we've been able to gather from our analysis is that price was in an uptrend, or generally is in an uptrend. Currently, price has made a higher low, and in that higher low, price is ranging. And within this range, price is at what? The support zone. And we say that in trading a ranging market, you buy from the support and you sell from the resistance. So let's go to the next lower time frame to see if we can get buying opportunities here. So we'll go to the H4 time frame. Good. Now on the H4 time frame, if I'm to zoom out, we can see that price made a lower high, a lower low, lower high, lower low into the zone. And currently, we can start now looking out for there are things that we see here that will encourage us to take a buy trade. Remember that our bias is to look for what? A buy trade. Now, just maybe from experience, from merely looking at this zone, I can see something like an inverse head and shoulder forming. Now, an inverse head and shoulder, for those of us that are not conversant with it, is a bullish reversal chart pattern, which means that if price is in a bearish direction, if price is going downwards, which is in a bearish direction, if price is in a bearish direction, excuse me, my network is terrible. Okay. We say it's a bullish reversal pattern, which means that if price is in a bearish or downwards direction, immediately this pattern appears, then it starts, it's like a signal that price is about to start what? Going upwards. Now, how do we trade this inverse head and shoulder? I've explained this in some of my previous videos. So if we have what? Price coming downwards, it goes upwards. Sellers push the price downwards to form what? A lower low. Then buyers push it upwards to try to form a high. And then sellers push it upwards but couldn't form a new lower low. Then buyers push it up again in an attempt to form a high. Now, what we observe is that in all of the cases, price is usually rejected from one point. So in that case, let's say price was rejected from this point. So we had sellers trying to push the price down. They formed a low, couldn't form, they formed a low, formed a lower high, formed a lower low, came back to form a lower, instead of forming a lower high, they formed a double top. Now, instead of pushing price beyond the initial low to form a lower low, they couldn't. Instead, they formed a higher low. And instead of buyers now coming into the market to form what? A higher high, they couldn't. Price was stuck at what? The same price level. Now, this price level at which price is currently stuck is what we now call what? The neckline. So the basic rule for trading this particular inverse head and shoulder chart pattern is that we wait for price to break this neckline, and then we wait for price to make a retracement. Once price breaks this neckline, we wait for price to make a retracement back to the neckline, and then we take our trade. So now, what we've just explained now, let's try to apply it to what we have here. Let me zoom out a bit. So we might have to go to the next lower time frame, but if I'm to map this out, let me use this tool. So it won't be confusing to us. So if I'm to take this as my left shoulder, I'll take this as the head, and I can take this area as my what? Right shoulder. And then I can take this upper part of it as my what? Neckline. Now it might not be very clear, but if we go down to the 1 hour time frame, let me zoom this in. If we go down to the 1 hour time frame, we can see that there's a big similarity between what we have here. Remember, on the chart, you will not have it this succinct. So now, if we look at this, we can see clearly that this is an what? Inverse head and shoulder pattern in a lower what? Time frame. So all we need to do now is to patiently wait for price to clearly break out of the zone. For price to clearly break out of the neckline, then we wait for a retest. When price comes back into the zone, all we now need to do would be to take our trade. Now, for some people who are much more aggressive, they can as well take their trade immediately, especially if you have like a big account size. So your stop loss would be underneath the right shoulder, and then of course you can wait for price to go all the way up. Now, this is my simple analysis using price action strategy, pure price action strategy to analyze the market. So like I said, you can use this basically to analyze, this method basically to analyze anything, and the win rate has been a testimony for the number of years that I've been doing this now. So if you're coming across this channel for the very first time and you feel that what you've just seen is of any use to you, I'd like to plead that you hit on the subscribe button, click on the like and share button for others to see this. And if if you are open for mentors, if you are open for more for further learning on how to do this on your own, you can reach out to me via my my WhatsApp contact on this YouTube bio. So, like I said, it's a trading academy. We have a lot of students that are currently doing well on their own. So, if you want to be like an independent trader, you want to learn the strategy from scratch, you want to learn what it takes to do this on your own and become a profitable trader, you can reach out. So once again, this is Oba FX signing out. Thanks a lot for your time. And for those of you that have subscribed and have been supporting this channel, I'm super grateful. Cheers.